You are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money.
For decades, U.S. Treasury bonds were the gold standard of stability, the ultimate safe haven in any financial storm. But what if that bedrock is starting to crack? What if the very foundation of our financial system is showing signs of stress? Today, we're diving into a topic that's got top financial minds, from analysts to fund managers, privately expressing serious concerns about the direction of the bond market. Some are even fearing a major disruption on the horizon. If you want to understand what's really happening with your money, you need to hear this. Here's the thing. In 2025, the U.S. is expected to spend around $952 billion on interest payments for its national debt, more than the $859 billion set aside for defense. That's more than just a budget line, it signals deeper trouble. The big concern is trust. U.S. government bonds are central to global finance and retirement planning. Countries worldwide hold trillions in treasuries, assuming they're the safest asset available. But if confidence fades, the impact could shake the global economy. Signs of strain are already appearing. Interest rates are climbing, and investor anxiety is rising. These aren't just whispers. Some of the most respected voices in finance are raising alarms. Jamie Dimon, CEO of JP Morgan Chase, which manages $4 trillion in assets, didn't mince words. We are going to see a crack in the bond market. It's going to happen. I just don't know if it's in 6 months or 6 years. That's significant coming from the head of one of the world's largest banks. Why the worry? U.S. debt has hit $36.6 trillion, 124% of the nation's GDP. During the 2008 financial crisis, it was 68%. That's a massive increase in less than 2 decades. Dimon isn't alone. Financial analyst Lynn Alden sees troubling trends. When stocks are down, bonds are down, yields are up, the dollar is down, and gold is up. That's like the market betting against the U.S. In other words, global investors are looking elsewhere for safety. Compounding the issue, the U.S. is running a $1.9 trillion annual deficit, about 6.2% of GDP. That level of overspending simply can't continue forever. Dimon blames reckless COVID-era spending and warns that if faith in U.S. bonds erodes, borrowing will become more expensive. That would drive up costs for everything from mortgages to business loans, and could weaken the dollar. Markets are already reacting. In May, the yield on 30-year Treasury bonds jumped by 0.25 percentage points, the biggest spike since December. The 10-year yield now sits at 4.51%, compared to under 1% in 2020. Higher yields mean investors are demanding better returns to compensate for perceived risk. But the concern goes beyond short-term interest rates. Dimon argues the U.S. must address structural problems: slow permitting, a broken tax code, rising healthcare costs, and underfunded education. He stresses the importance of national strength, not just economic, but also military. He even criticized speculative trends like cryptocurrency, suggesting Americans should invest instead in critical industries like defense tech and rare earth minerals. Why rare earths? Because China dominates them. In 2024, China tightened exports of minerals like gallium and germanium, essential for missiles and fighter jets, signaling it's ready to use its supply chain leverage strategically. China's influence doesn't stop there. It now has the world's largest navy by ship count, advanced drone capabilities, a strong grip on global 5G infrastructure, and a homegrown GPS rival. Through its digital Silk Road, it's spreading its tech across the global south. Dimon's not without critics. U.S. Treasury Secretary Scott Bessent pushed back, pointing out Dimon has made bold predictions before that didn't materialize. Still, dismissing these concerns entirely seems risky, especially as both foreign and domestic demand for U.S. bonds appears to be waning. American banks and pension funds are approaching their limits on how much government debt they can hold. If fewer buyers show up, the U.S. may have to raise interest rates even more to lure lenders, creating a cycle of rising borrowing costs that feeds the problem. Dimon warns that if global investors lose trust, America's status as the world's financial leader could be in jeopardy. A weakened dollar and higher borrowing costs could force cuts in defense and foreign aid, key tools for U.S. influence. So far, Washington hasn't shown much appetite for reform. Efforts to fix the tax code, rein in spending, or reform healthcare have gone nowhere. Without changes, the debt spiral will continue, potentially damaging the economy and America's global standing. And it's not just the US feeling the pressure. Even Japan, long considered a haven for safe government bonds, is seeing cracks. Since 2019, its 30-year bonds have dropped 45% in value while rates have soared. Some fear the US could face a similar fate, only faster. Lynn Alden sees this as a slow-burning crisis born from decades of bad decisions. She warns that the era of ultra-low interest rates, used to make debt more manageable, is over. Now, as rates rise, debt costs are exploding. She blames a mix of costly wars, an aging population, and unaffordable government promises like Social Security. With baby boomers retiring, fewer workers are around to support a growing number of retirees. According to Alden, this isn't just a policy issue, it's structural. Even drastic measures like deep spending cuts or tax hikes might not be enough, and could even backfire by slowing the economy or triggering inflation. And there's another major problem: trade. For over 50 years, the US has imported more than it exports, a side effect of having the world's reserve currency. The US buys foreign goods, and those countries recycle the dollars back into US assets. This cycle once worked smoothly, but now it's fraying. In 2024, global trade hit $33 trillion, with over half done in US dollars. But keeping that system running has hollowed out American manufacturing. Jobs have moved overseas, factories have shut down, and many towns have never recovered. If the US tried to fix its trade imbalance, it could choke the global dollar supply, causing worldwide debt issues and interest rate spikes. Most global debt is dollar-denominated. Without a steady supply of dollars, defaults could ripple through the system. This leaves the US in a bind. To maintain its role as the world's reserve currency, it must keep running deficits, but doing so hurts its own economy. Alden questions whether the cost of this status is still worth it. Meanwhile, the political system remains gridlocked. Lawmakers keep spending more regardless of the consequences. A good example: under President Trump, Congress passed a bill that claimed to save $1.3 trillion, but paired it with $3.7 trillion in tax cuts. The net result? $2.4 trillion more in debt. Neither party seems willing to make tough calls. Republicans want tax breaks, Democrats want expanded programs, but both shy away from real fiscal reform. The focus is on winning the next election, not fixing long-term issues. As debt grows, less money is left for essentials like infrastructure or education. A rising share of the budget goes just to interest payments. If this trend continues, it could erode confidence in the US economy and its global role. Diamond and Alden's warnings aren't just theoretical, they reflect troubling realities. If ignored, the consequences could stretch far beyond Wall Street, threatening America's financial stability and global leadership. The big question remains: is there still time to steer away from disaster, or are we already on the brink? If you're concerned about your financial security and are thinking about investing, check out the first link in the description. It's the platform I use, Interactive Brokers. Click the link to learn more. We hope you found this video helpful. If you did, please like and subscribe to our YouTube channel so you don't miss out on future uploads.